Defining your financial goals is the first step toward successful investing. Clearly outlining what you want to achieve will drive your investment strategy and decision-making. Consider your long-term aspirations, such as retirement, purchasing a home, or funding your children's education. These goals will shape the types of investments you choose and the level of risk you're willing to take. Remember, the more specific and realistic your goals are, the better equipped you'll be to create an effective investment plan. Determining your risk tolerance is crucial for making informed investment decisions. It assesses your comfort level with potential losses and helps you choose investments that align with your financial goals and emotional resilience. Consider your age, investment horizon, and financial situation to gauge your tolerance for risk. If you're young and have a long investment horizon, you may be more comfortable with higher-risk investments that have the potential for greater returns. Conversely, if you're closer to retirement or have a lower risk tolerance, you may prefer more conservative investments that prioritize capital preservation. Selecting the right brokerage firm and investment account is essential for your investment journey. Research different firms to find one that offers the services and features you need, such as low fees, a user-friendly platform, and access to the investments you're interested in. Consider your investment goals, the types of investments you plan to make, and any additional services you may require, such as financial planning or retirement planning tools. Once you've chosen a brokerage firm, open an account that aligns with your investment objectives. Whether it's a traditional brokerage account, an IRA, or a 401k, choose an account that provides tax advantages or other benefits that suit your financial situation. Choosing the right investments is crucial for achieving your financial goals. Research different types of investments to understand their risk and return profiles. Stocks represent ownership in companies and have the potential for higher returns but also carry more risk. Bonds are loans you make to companies or governments and generally offer lower returns but are considered less risky. Mutual funds provide diversification by investing in a basket of stocks or bonds, spreading your risk across multiple investments. Consider your risk tolerance, investment horizon, and financial goals when selecting investments. Consult with a financial advisor if needed to create a diversified portfolio that aligns with your unique circumstances and objectives. Regularly monitoring your investments is crucial to ensure they continue to align with your goals and risk tolerance. The financial landscape is constantly evolving, and your investments should be adjusted accordingly. Review your portfolio's performance, assess your risk tolerance, and make changes as needed. Rebalance your portfolio to maintain your desired asset allocation, and consider selling investments that are no longer performing or that have become too risky. Monitoring your investments also allows you to take advantage of market opportunities and make timely adjustments to maximize your returns. Remember, investing is a dynamic process, and ongoing monitoring and adjustment are essential for long-term success.